Be proud. Be brave. Be strong. But most of all, be prepared.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the Retirement Answer Man, Roger Whitney.
So the other day I was at yoga class and we were doing these crazy side planks where you were balancing on your feet and on your hand and your body was stiff in between. And I was wobbling all over the place and falling down a couple times. It was a little frustrating. After class, the yoga instructor came up to me and says, "Don't worry about it. What happens is, Roger, you tend to rely on your strongest muscle groups. And that means that your body gets out of balance. You're just as important, but smaller muscle groups get weaker. And by doing these side planks, they activate them to bring more balance to your body, which will protect you, your vessel, your body, as you get older." Well, you got to do the same thing with your investment portfolio as well. And we're going to do that today in the Hot Topic segment in this market correction fire drill. And then in our practical planning segment, we're going to answer some of your questions. Nicole's coming back on the show. I'm going to see if I can figure out what she got me for Christmas. But we can't do any of that until we have that all-important disclaimer. So if you take advice from people that don't know you, say me on this podcast or some other podcast or blog or a friend that you happen to be having coffee with, you're probably going to have a investment portfolio or diet or whatever it is you're taking advice on way out of balance, because those people, like me, don't know the entire picture of you. So think of this as helpful hints in education. Probably best to take advice from people that know your entire situation, like your legal advisor, your tax advisor, or your financial advisor. Now, we may talk about some indexes and investing today. It's important to remember you can't invest in an index. And if we talk about past performance, well, no guarantee of future results. And different investment profiles have different levels of risk. So it's important to make sure that's in balance as well. Now, let's get to the Hot Topic segment.
This is a test. This station is conducting a test of the emergency broadcasting system. This is only a test.
Hey, welcome to week 2 of the market correction fire drill, where we're trying to do a test of our ability to withstand a market correction and not derail our retirement. So last week we talked about understanding how much risk you're taking right now in your portfolio and as best you can dialing that in relative to the life goals, the retirement goals you want to live. So in week 2, what we want to do is we want to talk about rebalancing your portfolio to the risk level that you've intentionally set for yourself. So, maybe that's 60% in stocks and 40% in bonds. Maybe that's what you decided back in January 1st of this year. Well, here we are in December, and we've had a great year in stocks. Bonds have done, So if you haven't done anything, you're probably not at that 60% stock, 40% bond allocation that you might have decided back in January. That's a problem. Maybe you're 70% in stocks now and 30% in bonds. Well, that's a different risk profile. Now you're on a whole different ride that might be a little bit more volatile than you originally signed up for. It feels good right now because we're feeling the good results of performance, but it could set problems for you along the way. That's why rebalancing can be so important. So what does rebalancing mean? Let's start off there. When we're talking about a portfolio, what does it mean to rebalance? Well, the idea is if you've thoughtfully built a portfolio of, say, 60% stocks, 40% bonds, you have an understanding of how much volatility that portfolio could potentially have, at least using history as a guide, then you want to make sure you stay at or near that consistently. And when different assets move, that balance can get, out of balance. So we got to get it back into balance. That's basically what rebalancing is. So it involves selling things that are in a higher percentage than they're supposed to be and buying the things that are in a lower percentage than they're supposed to be. So in this scenario, given how markets have been, it may be selling some of your equity exposure and buying some of your bond exposure. Now, there are a couple ways that people rebalance typically. Number one is they go to a strict rebalancing policy, which means if you're supposed to be 60% in stocks and 40% in bonds, when you rebalance, say at the end of the year, you go right back to a hard 60%, 40%. So that's a strict rebalancing policy. That's one option. The other option is you allow it to have some range. So let's say you're supposed to be 60% in stocks. You say, yeah, but I can be as much as 65 and as low as 55. I'm just using this as an example. And that can help do a couple things. One is it can help winners run a little bit more because you're not constantly getting back to the strict policy. Two, it can decrease trading costs because you likely won't have to trade as much as you would in a strict policy. And three, it might be able to help minimize taxes because you're not constantly selling things going back to that strict policy. So those are the two types of rebalancing that I typically see. Now, the next question is, well, how often should you rebalance? I know people that rebalance monthly, meaning they're going back to their targets every single month. Every study that I've seen that was in depth said the frequency of rebalancing really just needs to be annually. It doesn't have to be any more than that. You don't really have a lot more benefit by doing it more frequently. And again, based on studies, historically, the best time to rebalance is usually in the first quarter. One, you get to the next tax year. And based on some reports I've seen looking at historical, that's usually the best time to do it. But I want to talk about why most people don't rebalance. It's actually a harder thing to do than you realize if you're managing your own portfolio, because think about what rebalancing is asking you to do. It's asking you to go against a lot of your natural instincts, meaning that to rebalance is asking you to sell the things that are doing really well. That's why they're higher than they need to be from an allocation standpoint. So it's asking you to sell the things that are doing really well, which in really the things you probably want to buy more of. That's what human nature says. Give me more of the good. And then it's asking you to buy the things that aren't doing well, which are really the things you want to have less of. So it's a little counterintuitive, right? I mean, this year doesn't feel like it's really hard, but imagine if you were in 2008 when at the bottom, the rebalancing policy is asking you to buy more of the things you're most frightened about, more stocks in that instance, and sell the things that are feeling safe. It was cash or bonds in that instance. So rebalancing is really hard to do because it's very counterintuitive, just because of our human nature of wanting more of good, less of bad. But over time, what rebalancing does is it's a strict policy that helps you sell high, right? Sell when things are doing extremely well in a systematic way and keep buying things that are going down in price or not moving in price, which, could be called buying low. It takes some time to work out. One of the things you have to agree with on the front end is that there are long-term cycles to asset prices, meaning they go up and down and they go in different formats because asset allocation believes that. And rebalancing is a systematic way of continuing to skim off the good and move it back to the things that are currently out of favor. So it's a really difficult thing to do. But for our purposes, what I really care about in this market correction fire drill is that we are targeting the minimum effective dose of risk, or the risk that you intentionally agreed to take, and we don't let that get too far out of whack. Now, I'm not a strict rebalancer. I believe in allowing things to float a little bit, but it's important that we understand what kind of ride we are. Can you imagine being on, going to Six Flags or something? You get on, the little cars that just sort of putz around, that have the little rail that don't let you drive off the road. Imagine getting on that ride and then all of a sudden finding yourself on a roller coaster. Well, that can happen if you don't rebalance. So that is our second step in this market correction fire drill. Now let's go answer some listener questions. Well, welcome back, Nicole, to the show. I have two questions for you.
Okay. Shoot.
One, how was Christmas shopping?
It was wonderful. I think I'm almost done.
Okay. And 2, is it bigger than a bread box?
The thing that I got you?
The special present that you got me, yeah.
Yes, it is bigger than a bread box.
Okay, so that means it's not an iPhone 10, so a little womp there, but makes up for quantity, I guess, because it's bigger.
Well, if you want to, we can talk about raising my salary, and then we can totally talk about that iPhone 10.
Okay, so we have questions today on the show. And who's our first question from, Nicole?
Nice change of topic there, by the way. Our first question is from Andy, who says, happy 200th episode. Roger, you didn't do anything to celebrate. 200 episodes is a lot.
I'm like a shark. I just keep moving. That is a lot. I mean, I sort of knew it was 200, but then after I had created the outline, I just didn't that's one thing you're really good at. So we'll make sure we celebrate.
We need to commit. When you get to 250, we're going to do something celebratory.
We're going to have maybe we'll involve the listeners in this as well, because they're a big part of this, a bicentennial celebration.
I love that. I think we should totally do that.
Okay, we'll definitely do that. Okay, so what does Andy have to say?
Back to Andy's question. So he has a question. We talked a little bit last week about the example case in the Hot Topic, and that was sent out in 6 Shot Saturday. So he has a question on that. He wants to know how a portfolio that is 100% stocks versus a portfolio that's only 50% stocks can affect the outcome of success by only 1%.
That's a good question. So if you listen to last week's episode on Hot Topic, we used an example talking about minimum effective dose of risk. The idea of, you only take as much risk as you need to live the life that you want. And we had this guy, it was Bob. Bob wanted $70,000 a year for 30 years off of $1.6 million. And that I excluded Social Security, so that was just from the assets. And I think what Andy's getting to is I provided a scenario of, hey, if we have a portfolio that's roughly 50% stocks, it has a probability of success using the analysis that we use of about 82%. And if we use a portfolio that's 100% stocks, it has a probability of success about 81%, which is showing, wow, he doesn't need to take near as much risk as he thinks he needs to take. And Andy is asking, hey, wait a second, that 100% stock portfolio could go down 51% like it did in the Great Recession. How could the probability of success be so close? And so one is it doesn't factor in the Great Recession in all of the scenarios. So the best way to think about that is where you're right, Andy, is, yeah, it may have the same probability of success, but that confidence ratio, that 81%, is going to be a lot more volatile because the portfolio is going to be a lot more volatile, meaning that you could veer off course really quickly in a market correction to where that confidence level will go down significantly. Whereas with the more conservative portfolio, even though the probability of success in today's data is roughly the same, it's going to be a lot more stable in terms of being impacted by the ups or downs of markets. Does that make sense?
Makes sense.
So one, we're excluding Social Security, and 2 is this is only like checking a compass at one point in time. So in the more balanced portfolio, you have a portfolio that's going to stay on course a little bit more, meaning it won't get a lot more upside, but it won't get a lot more downside. So it's going to be a little bit more tighter journey, a more stable journey potentially. Whereas the 100% stock portfolio could really veer off course in both directions, good or bad.
Our next question is from Bob, and he writes, I've heard a few times on the radio about the benefit of paying your January mortgage payment in December. Is there some tax benefit, and can you explain?
So Bob, that strategy is about moving the interest that you're going to pay on your mortgage into the current tax year. So by making the extra payment early, you get to take that tax deduction in the current year rather than the next year. Now, I'm not a tax advisor, so talk to your CPA. Now, one thing to consider before the end of the year, so this might be a little hard depending on where you live and how flexible you are, is the pending tax bill, at least it's pending as the time we're talking here, is looking at limiting real estate tax deduction on your home to $10,000. So if you pay real estate taxes over $10,000, it might make sense to pay that in 2017 for your 2018 bill, because that will allow you to take that deduction. At least that's my understanding. Whereas if you wait and pay it in 2018, you might not get it. Again, this is all up in the air, but something to consider and talk to your CPA about.
Our next question is from Dolphus, and he writes, how do you go about making an intelligent decision between an annuity and a lump sum? I'm looking at about $700,000 lump sum or about $60,000 a year with survivor benefits. I know there are a lot of variables. Something for me to ponder. Keep up the good work.
Hey, Dolphus. Well, first off, I struggle with making intelligent decisions all the time. Right, Nicole?
No comment.
Okay, thank you. For me, my preferred method is to model both options side by side, connected to the life that you're envisioning, those dreams, wants, and wishes in retirement. That cash flow model that we talk about over and over, because then we can model which one positions you, at least statistically, for the best chance of success. So that's my preferred method. Here are some things that go into it that you're right. It is difficult because you have a lot of different things factored into it. You have age, right? You have, okay, how old are you to get an idea of how long you'll be receiving this pension? And in this case, if you have a survivor benefit, the age difference between you and your spouse and what you're looking at longevity for, that's a big thing. What other assets do you have on your balance sheet in terms of having liquidity? You know, if you take the pension, yeah, you got the guaranteed payments, but then it may hamper you from asset and access to liquidity in the event that you need it. Another thing you got to factor in is your spending plans, your legacy goals, right? With a pension, you don't have any money to be able to pass on. I've had some instances with clients where the pension was a good deal, but they had ample assets to cover their life that it made sense for them to take the lump sum and invest it because really they were investing for multi-generational transfer. So that can be an important thing. So all these things come into play. And the only way I found to really decide from a holistic standpoint is to do all of the analysis based on the life that you're trying to live. And I know that may not give you a simple answer. Now, from a simple math perspective, the question really comes down to, can I generate a similar income if I were to take the $70,000 or $700,000, excuse me. Nicole was about to correct me. I saw her there. So in option one, I take $700,000. If I were to invest that, what type of growth could I get and what type of income could I generate off of that? Versus just taking the guaranteed payments of $60,000 a year. So let's take $60,000 and divide that by $700,000. That's about an 8.5% distribution rate. That's pretty good. That would be very difficult to replicate by taking that money and investing it. So, that might lead, depending on all those other factors, that maybe the pension's a better deal, but you really got to factor it all in. All right, now let's move on to our Happy Lab. The pre-Christmas Happy Lab. Hey, Nicole. Welcome to the Happy Lab, where we noodle on how to, in this case, have a happy, Merry Christmas, right?
I'll have a happy Christmas. Why not?
Why not? We'll make it happy. Now, Christmas has been said to be one of the most stressful times of the year for families, right? When it's supposed to be one of the happiest.
For me, I hate it because that's not what the season is about, but I easily fall into that trap of getting stressed.
So what makes you stressed?
I think feeling like I need to be thoughtful and provide all of these super thoughtful gifts and make sure that I see everyone that wants to see us, and just kind of those expectations that get built into the holiday get a little overwhelming.
I think that's the key word. Expectations of, in your case, as Mama Bear, making sure you meet your boys and your husbands, the expectations you put upon them, right? Of a joyful Christmas and obviously all the family expectations. And it feels like you're running around just checking the boxes rather than enjoying the day, right?
Right.
Right. So I think a key to a great, very merry or happy Christmas is trying to check yourself, right? And just, it's supposed to be enjoying people, not creating something for them necessarily.
Just enjoying the day and being together, and yeah. Like
with me, I'll give you a great example, is I really have to control my expectations. Like your gift. I'm really expecting squat, so I'm going to be happy with, whatever you got me. If I had...
You're going to love what I got you. Okay, I know it.
Okay. But if I was expecting, I remember my son, who is 20 now, but man, when he was young, like your boy's age, he would get so stressed about the giving or getting part of Christmas that it almost zapped all the joy. So I think it's important to teach those lessons. It's all about enjoying each other rather than feeling you're responsible to do all these things to make other people happy necessarily. All right, that's a good Christmas tip. So enjoy the day. Be happy.
On your marks, get set.
And we're off to the Smart Sprint of the week. Now, this is related to the market correction fire drill that we're doing. In the next 7 days, look at your asset allocation, your portfolio, and make sure that you rebalance to the appropriate allocation, the risk-reward trade-off that is tied to your goals. Remember, last week we talked about know what your risk is and have it tied to your goals. This week, we need to make sure we rebalance because we've had such amazing markets. If we don't rebalance, we could be out of balance, which could set you up for a lot more risk than you really want. So go do that in the next 7 days while you're winding down from work and enjoying the family.
One of my very favorite parts about working with Roger is that we get to talk to people all over the country about their retirement journey. And it's really awesome to hear all of your stories. We're accepting clients, and if you'd like to work with us, please go to rogerwhitney.com and click on Work With Us.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.